Most people hear the number $2 million and instantly assume it belongs to someone else, someone luckier, smarter, or born with advantages they didn't have. But that belief says far more about their mindset than about money itself. Because the truth is, very few people reach this level of wealth not due to lack of opportunity, but because their psychological framework collapses long before the compounding ever begins. Having $2 million in retirement isn't a privilege reserved for the elite. It's the natural outcome of a belief system built on patience, discipline, and emotional neutrality. Yet most individuals never reach it because they approach money with fear, urgency, and short-term thinking, biases that quietly erode their ability to stay consistent. What people fail to understand is this: wealth doesn't grow in markets, it grows in the mind. Your financial outcome is simply a reflection of how well you handle uncertainty, how committed you are to long-term processes, and how stable you remain when everyone else is emotionally reacting. The small minority who do reach $2 million aren't special. They simply mastered what the majority ignore: the psychological principles of ownership, consistency, and belief in probabilistic outcomes. They understood that every contribution, every reinvested gain, every year of patience is part of a larger game, one that rewards those who stay aligned with process over emotion. So when you look at the statistics and see how few people actually hit that number, don't be intimidated by it, be awakened by it. Because the gap isn't financial, it's psychological. And once you learn to think in probabilities, act with discipline, and stay emotionally balanced, you'll find that the path to $2 million is not only possible, it's predictable. The question isn't who has $2 million. The real question is, who has the mindset to get there? And that can be you, if you choose it. Most people don't achieve $2 million in retirement because their beliefs about money, risk, and long-term commitment sabotage them long before their strategy does. The numbers are not the barrier. The income is not the barrier. The lack of opportunity is not the barrier. The true obstacle is the internal framework, the invisible belief system that quietly governs decisions, reactions, and consistency over decades. Most people never see this structure operating, but it dictates everything: how they save, how they invest, how they react to market uncertainty, and ultimately how much wealth they create. People say they want financial freedom. They say they want security. They say they want a comfortable retirement. But the moment the market dips, the moment a strategy takes longer than expected, the moment real patience is required, their internal dialogue begins poisoning the process. Fear whispers. Doubt intrudes. Short-term thinking hijacks long-term goals. And without realizing it, they drift away from the behavior that builds wealth and into the behavior that destroys it. They think it's a money problem, but it's a belief problem. They think it's a strategy problem, but it's a psychological problem. They think it's an external issue, when in reality, the internal response to uncertainty is what collapses their path to wealth. Most people have never been taught how to think in probabilities. They have been conditioned to see every financial decision as win or lose, success or failure, gain or loss. This binary thinking creates emotional pressure, and emotional pressure leads to impulsive decisions. When your mind is interpreting every small setback as a threat, your behavior becomes reactive instead of strategic. You pull money out at the worst time. You stop contributing because you don't feel safe. You jump from one strategy to another because consistency feels boring. And consistency, quiet, disciplined, unexciting consistency, is the soul of compounding. Without it, no strategy on earth can save you. The people who never make it to $2 million are not lacking intelligence. They are lacking emotional neutrality. They don't know how to hold a long-term commitment without needing constant reassurance. They don't know how to stay aligned with a plan when the plan stops mirroring their expectations. They want the outcome but resist the process. They want the destination but sabotage the journey because the journey doesn't feel good every step of the way. They don't realize that wealth is built in the moments when nothing seems to be happening, when the market is sideways, when contributions feel small, when progress looks invisible. This is where the internal war either stabilizes or collapses, and most people collapse. Human beings are wired for immediacy. We crave feedback. We crave certainty. We crave visible progress. But long-term wealth creation does not satisfy those cravings. It demands patience. It demands discomfort. It demands a belief system strong enough to withstand periods where nothing in your external environment validates your effort. When beliefs are weak, actions are inconsistent. And inconsistency is the single greatest enemy of compounding. Ask someone who never built real savings why they didn't succeed, and they will point to their circumstances. They will tell you the market was too volatile, or their job didn't pay enough, or expenses were too high, or opportunities didn't come. Very few will admit the deeper truth. They sabotage themselves by responding emotionally to events that required neutrality. They pulled out when they should have stayed in. They chase quick gains instead of slow growth. They let fear dictate decisions that required confidence. They let impatience distort a process that demanded time. They allowed external noise to override internal discipline. Fear of loss is one of the most powerful psychological forces in human behavior. In markets and retirement planning, this fear is amplified because money represents security, freedom, identity, and future safety. When people see even small fluctuations, they interpret it as danger. Their nervous system treats a 5% drop as a personal threat. They forget the long-term context. They forget the probabilistic nature of markets. They forget that volatility is the price of admission for long-term reward. And in that emotional fog, they make decisions that permanently derail their future. Most people never lose money in the markets. They lose money to their reactions. Another subtle belief that destroys wealth is the illusion of not enough. People tell themselves their income is too small to build real savings, so they don't even start. Or they contribute irregularly because they believe small contributions don't matter. They underestimate the power of compounding because they cannot emotionally feel the future value of small actions. They believe wealth requires big moves. In reality, wealth requires small moves repeated consistently over long periods. The small moves are easy. The repetition is hard. And repetition fails when beliefs are weak. There is also the belief that wealth is a function of intelligence or luck. This belief paralyzes people because it removes personal responsibility. When someone believes wealth is for the lucky few, they no longer see their own habits as the driving force. They assume external forces decide their fate. This belief destroys motivation, consistency, and long-term commitment. In trading and investing, as in life, the beliefs you hold about yourself become the boundaries of your behavior. Most people are also deeply uncomfortable with delayed gratification. They want the comfort of spending now instead of the satisfaction of building later. They justify it as living life. But in reality, they are soothing emotional impulses at the expense of long-term security. A belief system that prioritizes short-term comfort over long-term strength will always lead to financial fragility. Then there is the fear of boredom. People underestimate how psychologically difficult it is to do the same simple things for years without emotional stimulation. Contributing monthly, investing consistently, staying in the market through ups and downs, this is boring. And when something is boring, the mind begins searching for excitement elsewhere. People take unnecessary risks. They chase trends. They abandon stable strategies for something that feels better. They mistake excitement for progress. And excitement is one of the fastest ways to destroy wealth. The minority who do reach $2 million did not get there because they are special. They got there because they built a belief system that supports consistency. They learned to accept uncertainty instead of fighting it. They learned to see markets probabilistically instead of emotionally. They learned that wealth is not something you chase. It is something you allow to grow by staying out of the way. They learned that patience is not passive. It is an active psychological skill rooted in trust. If you look deeply, wealth creation is not really about money at all. It is a test of your relationship with uncertainty. It is a test of your ability to stick to a plan that does not reward you immediately. It is a test of whether your beliefs support long-term thinking or sabotage it. It is a test of whether you can maintain internal stability regardless of external noise. Most people fail because they approach wealth with the same mindset they use for daily life: reactive, emotional, expectation-driven, and deeply uncomfortable with uncertainty. But wealth requires the opposite: neutrality, patience, process-driven thinking, and an acceptance that the uncertainty you feel is not a threat, but the environment in which compounding thrives. The truth is simple. The gap between those who build $2 million and those who don't is psychological, not financial. The market doesn't prevent people from becoming wealthy. Their beliefs do. Their inability to manage fear, impatience, and uncertainty prevents them from engaging in the behaviors that lead to long-term success. The strategies exist. The math works. The opportunities are available. But belief systems determine whether you execute consistently enough to realize the outcome. Most people never build real wealth because they underestimate their own mind's ability to interfere with progress. They think they need a different plan, a higher income, or better timing. In reality, they need a different relationship with uncertainty. They need different beliefs about risk. They need emotional discipline. They need patience. The ones who reach 2 millions don't have better markets. They have better psychology. They see uncertainty as normal, not threatening. They see time as an ally, not an obstacle. They see small contributions as powerful, not meaningless. They see volatility as opportunity, not danger. They see commitment as liberation, not restriction. Wealth is built from the inside out, and until beliefs change, results never do. Wealth is not a function of income, but of psychological discipline, your ability to stay consistent, patient, and emotionally neutral through years of uncertainty. People confuse wealth with earnings because they don't understand how the internal world shapes long-term results. They think the person with the higher salary will inevitably end up richer. They think the person with more opportunities will automatically build more financial security. But if income were the determining factor, every high earner would retire comfortably and every low earner would struggle. Yet reality shows the opposite. Many high earners stay broke, stressed, and insecure, while countless ordinary earners accumulate real wealth over time. The difference is not money, it is mindset. It is the internal ability to act consistently regardless of what emotions whisper, what the market does, or what temporary setbacks appear. Most people don't fail because they lack income. They fail because they lack the psychological structure required to turn income into lasting wealth. They let impulses override strategy. They let fear override patience. They let short-term emotions override long-term goals. And because their internal environment is unstable, their financial outcomes become unstable. Discipline, patience, and emotional neutrality are not optional components of wealth. They are the foundation on which wealth is built. Without them, no strategy can survive. Wealth grows slowly, and the human mind hates slow. The mind wants excitement, immediacy, confirmation. It wants to see progress now. It wants reassurance now. And when wealth building doesn't provide that emotional feedback, the mind starts searching for stimulation. It starts doubting the process. It starts imagining threats where there are none. This is where consistency fractures. People skip contributions because it doesn't matter this month. They panic sell because a small dip feels dangerous. They pull out because the market looks uncertain. They chase quick returns because waiting feels pointless. This psychological instability is the true cost that eats away at wealth, not volatility, not income, not external conditions. Two individuals can earn the same amount of money for 20 years. One ends up wealthy, the other ends up in survival mode. The difference lies in their internal responses to uncertainty. The wealthy one continued contributing even when it felt insignificant. They stayed invested even when the market dipped. They trusted the long-term process even in moments of doubt. They operated from principle, not emotion. Meanwhile, the other person reacted emotionally to every shift in the environment. They spent impulsively when they felt stressed. They withheld contributions when they felt uncertain. They abandoned strategies when they felt bored. They let emotions dictate behavior, and emotions do not compound. Disciplined processes do. Psychological discipline is the ability to hold your ground when your emotions are demanding action. Wealth building requires you to endure long stretches where nothing exciting happens. It requires you to accept the reality that progress is invisible most of the time. The compounding curve is deceptive. It requires years of what appears like stagnation before the late-stage exponential growth begins. Most people quit before that curve bends. They become impatient. They lose faith. They assume nothing is happening. But something is always happening, just not visibly. The people who succeed are those who can mentally tolerate the slow burn of delayed gratification. Emotional neutrality is another pillar. Markets rise, markets fall, and most people interpret every movement as a reflection of their personal security. A drop feels like danger, a rise feels like confirmation. Their emotions swing with every fluctuation, and those emotional swings drive destructive decisions. The mind begins to catastrophize. A 10% dip becomes the beginning of the end. A small loss becomes proof that this doesn't work. They forget that volatility is the natural environment of growth. Wealth is not built by avoiding volatility. Wealth is built by remaining neutral while volatility plays out. True emotional neutrality means you understand that movements in the market are not judgments of your intelligence or reflections of your safety. They are simply part of the probabilistic structure of long-term investing. When you stop personalizing market movement, you stop reacting to it in destructive ways. You stop selling at the bottom. You stop chasing the top. You stop abandoning strategies halfway through. You develop an internal calm that allows the external world to behave however it behaves without destabilizing your decisions. Staying consistent is perhaps the hardest psychological challenge, because consistency lacks drama. It lacks novelty. It requires repeating the same simple action regardless of whether it feels meaningful. The mind resists this because it equates sameness with stagnation. It wants change, stimulation, progress it can see. But consistency is not about emotion. It's about alignment with a long-term vision. It's about doing what works even when it feels like it's not working. It's about honoring the process more than your mood. The people who build wealth understand that consistency is an identity, not an action. It's who they choose to be regardless of circumstance. They do not need motivation to contribute. They do not need reassurance to stay invested. They do not need perfect conditions to remain disciplined. They understand that consistency is a decision that becomes powerful only when it is practiced over decades, not days. Contrast this with the average person whose financial life is a reflection of emotional cycles. When they feel optimistic, they invest. When they feel stressed, they withdraw. When they feel hopeful, they save. When they feel discouraged, they spend. Their financial behavior mirrors their emotional weather. And emotional weather is chaotic, unpredictable, and reactive. You cannot build long-term wealth on short-term emotions. Patience is another psychological asset that separates the wealthy from the reactive. Most people underestimate patience because they think patience means waiting. But in the context of wealth, patience means trusting. It means trusting the math, trusting the timeline, trusting the compounding effect even when nothing visible is happening. Patience is a form of emotional resilience. It allows you to stay aligned with long-term outcomes without being seduced by short-term temptations. Without patience, every dip looks like a warning, every delay looks like failure, and every slow period feels like proof that you need a new plan. The wealthy are not patient because they are calm. They are patient because they understand the dynamics of long-term growth. They know that the market does not reward urgency. It rewards those who can remain unfazed. Wealth is not created in moments of excitement. It is created in moments of boredom, in moments of uncertainty, in moments where others panic and you remain committed to the process. Belief systems play a profound role as well. People who struggle financially often carry limiting beliefs about money, about themselves, and about what's possible. They believe wealth is for others. They believe they are not good with money. They believe financial security is out of reach. These beliefs shape their behavior more powerfully than any strategy. If you subconsciously believe wealth is impossible for you, you will unconsciously sabotage every opportunity to build it. Not because you lack intelligence, but because your internal world is not aligned with the external outcome you claim to want. On the other hand, people who build wealth believe that the process works. They believe in the power of consistency. They believe in the logic of compounding. They believe that their long-term actions matter. These beliefs anchor their behavior, especially during difficult times. Beliefs determine emotional stability, and emotional stability determines financial behavior. You cannot out-earn a weak mindset. You cannot outsave emotional reactivity. You cannot build wealth with a psychology that collapses under uncertainty. Income is merely the raw material. Discipline is the machinery that shapes it. Without discipline, income is wasted. With discipline, even modest income can grow into real wealth. This is why wealth is not a function of how much you make, but how well you manage your internal environment. The world rewards those who behave with consistency, patience, and emotional calm, not those who simply earn more. Wealth is not built in the external world first. It is built internally. It is built in the way you think about uncertainty, risk, time, and commitment. It is built in your ability to stay grounded when everything around you fluctuates. It is built in your ability to stay patient when progress is invisible. It is built in your courage to ignore emotions that urge immediate action. It is built in your willingness to trust long-term processes more than short-term feelings. Most people fail to build wealth not because they lack opportunity, but because they lack the psychological discipline required to use opportunity effectively. But the moment you cultivate consistency, patience, and emotional neutrality, something extraordinary happens. The external world begins to reflect your internal stability. Wealth starts to accumulate. Progress starts to appear. The slow curve of compounding finally bends upward. And you realize that the outcome was never about income, only about who you had the discipline to become. Reaching $2 million is possible for far more people than it seems, but only for those who master the mindset that separates owners from reactors and long-term thinkers from short-term emotional traders. The number itself intimidates people because they imagine it belongs to a different class of individuals, those with higher incomes, privileged backgrounds, special knowledge, or extraordinary luck. But none of that explains why some people reach $2 million while others with similar or greater advantages never get close. The real difference is psychological. It's the difference between someone who thinks like an owner, calm, process-driven, strategic, and someone who reacts like a short-term trader, emotional, impulsive, frightened by uncertainty, addicted to immediacy. Wealth does not emerge from reacting. Wealth emerges from owning the process over decades. Most people do not fail because the $2 million goal is unrealistic. They fail because their beliefs about money, time, and risk make long-term behavior impossible. They chase quick wins, they panic at temporary losses, they abandon strategies that require patience, and they allow emotions to override logic. This emotional reactivity is the single greatest destroyer of wealth-building potential. It forces people to act inconsistently, and wealth cannot grow in an environment where actions lack continuity. To accumulate $2 million, you need an internal structure strong enough to keep you aligned with the plan even when your emotions try to pull you away from it. Owners understand this intuitively. They see wealth building like planting a tree. The early years show almost nothing, but the roots are developing unseen. A reactor looks at the same early years and sees failure. They assume nothing is happening because the results aren't visible yet. They get frustrated and dig up the tree to check its progress. They forget that compounding punishes impatience. Owners trust the process long before it produces visible results. Reactors trust only what they can see immediately, which means they never get far enough for compounding to reveal its power. Being an owner is less about financial knowledge and more about emotional mastery. Owners do not react to every market movement because they understand the nature of markets. They understand volatility is not a threat, but the environment in which returns are generated. They understand that long-term outcomes are shaped by behavior, not predictions. They accept that uncertainty is a permanent feature of wealth building, not a temporary obstacle. Because their beliefs are aligned with long-term thinking, their behavior remains stable even when conditions are not. Reactors behave in the opposite way. They are emotionally attached to movement, needing constant reassurance to feel secure. When the market rises, they feel confident. When it falls, they feel threatened. Their emotions swing with every chart, and those emotions dictate their decisions. Instead of following a strategy, they follow fear and excitement, two forces that destroy consistency. They pull money out when it feels scary, then re-enter when it feels safe, ignoring the fact that safety is usually found at the top and fear at the bottom. Their entire financial journey becomes a reflection of emotional impulses instead of rational planning. To reach $2 million, you must master the ability to remain steady while the world moves. You must hold a vision that extends years into the future, unaffected by the noise of today. You must build the mental strength to keep contributing during periods that feel stagnant, to remain invested during periods that feel dangerous, and to trust the compounding curve even when it is invisible. This kind of psychological discipline is not glamorous. It is not exciting. It is not dramatic. It is quiet, often boring, and absolutely essential. Most people underestimate just how psychological the journey to $2 million is. They believe the challenge is mathematical. Earn more, save more, invest more. But mathematics is the easiest part. The math already works. It has always worked. The true challenge is emotional. It is learning to manage impatience, fear, boredom, doubt, and the constant desire for certainty. These emotions sabotage far more wealth-building efforts than any external factor. People know what to do. They simply cannot bring themselves to do it consistently for long enough. They stare at their accounts and expect immediate payoff. When they don't see rapid growth, they get discouraged. They change strategies. They withdraw contributions. They lose faith. And the cycle repeats endlessly Owners understand that the market does not reward intensity, it rewards duration. It rewards those who stay engaged for decades, not months. It rewards those who survive the emotional storms instead of reacting to them. Owners know that every dip, every correction, every sideways year is part of the long-term cycle. They don't see these moments as threats. They see them as ordinary weather conditions on a long journey. They remain unmoved because their beliefs support emotional neutrality. They know that reacting emotionally to market movement is the same as steering a car based on every pebble on the road. The key difference between an owner and a reactor is how they relate to uncertainty. Reactors believe uncertainty is a signal to stop, withdraw, or change direction. They see uncertainty as danger. Owners see uncertainty as the normal operating environment of long-term investing. They expect it. They prepare for it. They build their psychology around it. They know the market will rise, fall, rise again, and fall again. They are not surprised by volatility because they understand its role. Their acceptance of uncertainty creates emotional stability, and emotional stability creates consistency. Consistency is the true engine behind reaching $2 million. Every contribution, every reinvested gain, every year of staying in the market compounds into something extraordinary. But those actions are only possible when your emotions no longer control your behavior. People who reach $2 million aren't necessarily the ones with the highest earnings. They are the ones with the strongest emotional discipline. They are not always the ones with the best strategies. They are the ones who stay with a good strategy long enough for it to work. They are not the ones who predict the future. They are the ones who stop trying to predict the future and focus on controlling their behavior. Short-term emotional traders fail not because the market is unfair, but because their mind cannot hold a long-term vision. They react to every fluctuation, treating temporary movement as permanent meaning. They misinterpret normal volatility as danger. They exaggerate short-term patterns into long-term threats. Their emotional worldview is too narrow to support long-term results. They want to win now. They want proof now. They want payoff now. But wealth is slow. Wealth is cumulative. Wealth is the child of time, not urgency. And short-term emotional thinking kills long-term opportunity. Reaching $2 million requires transforming your identity from someone who reacts to someone who owns. Owners think in decades, not days. They act based on principles, not impulses. They understand that the real battle is not in the market, but in the mind. They understand that every emotional urge to quit, panic, or rush is part of the psychological resistance that prevents most people from ever achieving significant wealth. They understand that mastering wealth means mastering themselves. People often ask what investment strategy will get them to $2 million. But the strategy is not the answer. There are countless strategies that work. The real question is, which strategy can you stick with for 20 or 30 years without emotionally sabotaging it? The moment you stop thinking like a reactor and start thinking like an owner, nearly any reasonable long-term plan becomes powerful. But without that mindset, even the best plan becomes useless. The ones who reach $2 million are not superhuman. They are simply individuals who have learned to detach from the emotional noise that distracts everyone else. They have trained their minds to accept uncertainty instead of fearing it. They have built the discipline to continue even when they feel nothing happening. They have internalized the truth that wealth is not an event. It is a long-term psychological performance. Every year they continue the process. Every moment they resist emotional shortcuts. Every decision they make from strength instead of fear adds up until eventually the number that once seemed impossible becomes inevitable. Reaching $2 million is not about luck, income, or market timing. It is about evolving into the kind of person who behaves in alignment with long-term success, regardless of emotional fluctuations. It is about shifting from a reactive mindset to an ownership mindset. It's about stepping into a belief system that supports patience, consistency, and neutrality. It is not the money that is difficult, it is the mindset. But the moment the mindset changes, the money follows. The path to $2 million is not reserved for the fortunate. It's reserved for the disciplined. It belongs to those who refuse to let emotions dictate decisions, who think in decades instead of moments, and who treat uncertainty as a normal cost of long-term growth. Wealth is never built by reacting. It is built by owning a process and staying aligned with it long after the excitement fades. When you master the mindset that outlasts fear, impatience, and short-term noise, the result becomes inevitable. The number isn't the victory. The transformation of your psychology is.